So in this example, it's saying that they're overstating purchases because like they received this item. Well, it was recorded, but like they haven't actually received it yet. So like there's 100,000 additional um, um, inventory, ghost inventory that actually hasn't been received. So it's actually not even there. So the purchases is overstated, and not only that, but like sometimes later on they do like a count of the ending inventory, and they realize that ending inventory is incorrect, so they fix the ending inventory. But in this case, they have not done that. Okay, so like here's an example of uh, the correct amount. That this is if it was correct. Like let's say the beginning inventory is $1 million worth of inventory. Beginning inventory is correct. Purchases was 200,000, and the ending inventory should be 500,000. But as you can see, what's recorded is that the current assets, as in like the ending inventory is 600,000, and the current liabilities, as in purchases, is 300,000. So because the ending inventory was not fixed, um, the purchases as well as the ending inventory would be overstated by the 100,000 each. So like, unless the ending inventory was fixed, then the cost of goods will have no effect. There won't be an effect to the cost of goods because the ending inventory as well as the purchases balance each other out. Those are actually both incorrect, but like because of that, the cost of goods actually is correct regardless. But that doesn't mean that the balance sheet is correct. The balance sheet is still incorrect. Okay, so like that's like one important thing to note about the inventory and like the misstatements of inventory. So like in this case, yes, the cost of goods has not changed. There's no effect to the cost of goods, but there's other things incorrect about this whole thing. Um, well, the cost of goods sold has no effect, so the net income will actually have no effect either, because the expenses are actually correct. So like the net income is actually correct. So like because the net income is correct, there's not going to be an effect on retained earnings as well as there's not going to be an effect on the stockholders' equity. But the current assets as well as the current liabilities actually are overstated. So like because those both are overstated by the same amount, the working capital is actually going to have no effect either because they're actually they're both overstated by the same amount. So the working capital will have no effect. But the current ratio, it will actually have an effect on the current ratio. The current ratio would be understated. So as you can see here, because the correct amount of current assets should be 500,000. The correct amount of current assets should be 200,000. So like if you want to look at the current ratio, it should be 2.5. But like because what was recorded incorrectly is 600,000 for the current assets as well as 300,000 for the current liabilities, the recorded current ratio is actually 2. So what was recorded is actually understated versus what should have been correctly recorded.